Welcome back, everyone. In the last three lectures, we covered the foundation of corporate finance, the discounted cash flow framework, and fixed income securities. Today, we turn to equity valuation models. Unlike bonds, stocks don't give us fixed payments or a maturity date. That means we need to bring together everything we learned about cash flows, discounting, and growth. We will explore the traditional dividend discounting framework, and then we will also look at multiples, which is widely used in practice. My goal today is to help you understand both the theory and the intuitions behind those models. So let's get started. Here's the roadmap for the lecture. We will start with dividend discounting models. We will look at the zero growth case, where dividends stay constant, then move to constant growth, and finally the non-constant or two-stage growth models. Along the way, we will also break down the components of the required return. Then in the second half of the lecture, we will switch gears to a non-discounting approach, valuation using multiples. This method is especially helpful when companies don't pay dividends. So by the end of the day, you will see both the rigorous discounted cash flow approach and the practical shortcut analysts often use in industry. Let's start by revisiting a core principle we've seen before. We know that the value of any asset equals the present value of its future cash flows. From a corporate perspective, we can think of an asset as nothing more than a sequence of cash flows that will arrive over time. These sequences are the building blocks of all of finance. On the timeline here, you can see cash flows at different points, CF1, CF2, and so on. The job of valuation is to discount each of those future payments back to today and add them up. That's why we always draw a timeline when solving those problems. It really helps us keep track of both the size and the timing of cash flows. So what does this mean for stocks? In your financial management class, you may have learned about the value of a stock depends on inputs like the dividends it pays, the required rate of return, the expected growth rate, and the payout ratio. These are all important pieces, but the big picture is broader. Stock valuation depends on expected cash flows and how risky those cash flows are. That's what makes equity valuation more challenging than valuing bonds. However, here's an important caveat. To really understand value, we need to understand risk and return, and also the trade-off between them. Step 1 is to always establish the value of expected dividends or cash flows. And step 2 is making sure that we are properly accounting for the risk of those cash flows. Investors will only accept risk if they are compensated with higher expected returns. So, as we go forward, we should keep this in mind. Valuation is not just about forecasting numbers, it's also about judging risk. In practice, there are three major approaches to valuing equity. The first one is discounted cash flow approach. Like the dividend discounted model or free cash flow models. The second one is market-based approach, where we use multiples such as PE ratio. And the third one is contingent claim approach. In this course, we will cover all three, but for now, our focus will be on the first two, dividend discounting and multiples, because they provide the essential tools you will use most often. Because they provide the essential tools you will use most often. Before diving deeper into valuation models, let's pause to remember ourselves what common stock really represents. Owning common stock means you are the owner of the corporation. Owning common stocks means you are an owner of the corporation. As a stockholder, you have two key rights. You are entitled to dividends, which could be in the form of cash payments or additional shares. You also have voting rights, which let you elect board of directors. You also have voting rights, which let you elect the board of directors. But unlike bondholders, you face uncertainty. The size and timing of dividends are not guaranteed. That's why stock valuation models must deal with this uncertainty head-on. That's why stock valuation models must deal with this uncertainty. Now let's compare equity and debt further, because the differences will highlight why equity valuation is trickier. Now let's compare equity with debt further, because the differences will highlight. Now let's compare equity with debt, because the differences will highlight why equity valuation is trickier. Debt includes bonds and loans. It requires fixed payments on a set schedule, and creditors have a legal right to be repaid. On the other hand, equity comes from stockholders. Payments depend on performance. If the company does poorly, dividends may be cut or skipped entirely. Equity can be raised by retaining earnings or selling shares. So right away, you can see that equity is riskier but also offers more upside potential than debt. Another difference is voice in management. Stockholders are the owners of the firm. They have voting rights, which allow them to elect directors and influence major corporate decisions. Creditors, in contrast, have no say in how the firm is run. Their influence comes only from contractual obligations. That is, they expect their payments on time, but they don't get to vote on policies. This is one of the big attractions of equity: ownership and control. Next, let's look at claims on income. Equity holders are residual claimants.
Claimants. Claimants.
Equity holders are residual claimants.
Claimants.
Equity holders are residual claimants. They get paid after all creditors have been satisfied. That means dividends are only paid once interest and the principal obligations have been met. This residual claim is a double-edged sword. On one hand, it creates unlimited upside, which means if the company performs well, equity holders can benefit enormously. On the other hand, if the firm is struggling, there may be nothing left for shareholders after creditors take their share. This trade-off explains why equity is riskier, but also why it offers higher expected returns compensated to debt. This trade-off explains why equity is riskier, but also why it offers higher expected returns compared to debt. When it comes to claims on assets, equity holders again take the residual position. If the firm is liquidated, another difference is voice in management. Stockholders are the owners of the firm. They have voting rights, which allow them to elect directors and influence major corporate decisions. Creditors in contracts have no say in how the firm is run. Their influence comes only from contractual obligations. They expect their payments on time, but they don't get to vote on policies. This is one of the big attractions of equity: ownership and control. Now let's look at claims on income. Equity holders are residual claimants. They get paid after all creditors have been satisfied. That means dividends are only paid once interest and the principal obligations have been met. This residual claim is a double-edged sword. On one hand, it creates unlimited upside. If the company performs well, equity holders can benefit enormously. On the other hand, if the firm is struggling, there may be nothing left for shareholders after creditors take their share. This trade-off explains why equity is riskier, but also why it offers higher expected returns compared to debt. When it comes to claims on assets, equity when it comes to illustrate it further, when it comes to claims on assets, equity holders again take the residual position. If the firm is liquidated, the proceeds will go first The proceeds will first go to the secured creditors, then unsecured creditors, and only then to equity holders. This means shareholders are the last in line, which makes their position riskier. But because they bear the risk, they also expect higher returns. That higher required return translates into a higher cost of equity financing for the firm compared to the cost of equity. That higher required return translates into a higher cost of equity financing for the firm compared to the cost of debt. As we stated at the beginning of the lecture, debt has a fixed maturity date. Eventually, principal must be repaid. Equity, in contrast, has no maturity. It represents permanent capital. This has two implications. First of all, equity doesn't need to be repaid, which gives firms financial flexibility. Second, it also means stockholders face uncertainty. They can only realize value by selling shares in the market, and market prices can fluctuate. So the lack of maturity makes equity riskier, but also potentially more valuable if the company grows over time. There's also a very important tax difference. Interest payments to debt holders are tax deductible, but dividend payments to stockholders are not. That makes debt cheaper from a tax perspective. A dollar of interest reduces taxable income, but a dollar of dividends does not. This tax shield is one reason why firms often prefer debt financing. This tax shield is one reason why firms often prefer debt financing. However, as we just discussed, debt also creates obligations and potential financial distress. So firms must balance the cost advantage of debt against the flexibility. So that means firms must balance the cost advantage of debt against the flexibility of equity. So here's a quick summary table. On management, debt has no say, but equity has voting rights. On claims, creditors are senior, but equity is subordinate.
Subordinate.
On claims, creditors are senior, but equity is On claims, creditors are senior, but equity is subordinate. On maturity, On maturity perspective, debt matures, but equity is permanent. Finally, interest is deductible, but dividends are not. This table highlights why equity holders face more risk, but also why they have higher expected returns. This table highlights why equity holders face more risk, but also why they have higher expected returns. This is because they will feed directly into the discount rates and models we keep this contrast in mind because they will fit directly into the discount rates and models. We keep this contrast in mind because we will keep this contrast in mind because they will fit directly into the discount rates and models we use for valuation. So what are the actual cash flows that stockholders receive? There are two ways you make money from holding a share. The first way is you may receive dividends, which are periodic cash distributions approved by the company's board. These are not guaranteed, but firms with stable dividend histories create shareholder expectations. Second, you may sell the stock, either to another investor in the secondary market or back to the company through buybacks. So stockholders' return comes from dividends plus capital gains. Both are uncertain, unlike coupon payments from bonds. Some companies don't pay dividends at all, especially small or high growth firms. They will reinvest everything back into the business. The question is, does that make them worthless? Absolutely not. Absolutely not. Absolutely not. The value of the stock is still tied to future dividends, but those dividends might come later once the firm matures. The key is that they can't be zero forever. Eventually, companies must return cash to shareholders. In some form, or else the shares won't have value, So when you see no dividends today, think of it as delayed dividends, not no value at all. Now we can formalize the general case. The value of a stock today, P0, equals the present value of all expected future dividends. This is the foundation of the dividend discount model, or DDM. Notice that the structure looks just like bond valuation, except the cash flows, dividends, are uncertain and may follow different patterns. That's why we develop special cases: zero growth, constant growth, and non-constant growth. This diagram shows how we discount dividends back to the present. The key step is forecasting the pattern. The key step is always to forecast the pattern of dividends. If dividends are constant, it's a perpetuity. If they grow at a constant rate, it's a growing perpetuity. Perpetuity. If they grow at a constant rate, it's a growing perpetuity. If they start off irregular, then stabilize, we use a two-stage or multi-stage model. So the heavy lifting in stock valuation is actually on the forecasting side. That is, estimating how dividends will evolve over time. Now, here's a broader way to look at discounted cash flow models. On the left, we start with the firm's cash flows, either operating earnings or free cash flow. Then, depending on the firm's growth assumptions, we forecast how those flows will evolve. For equity, we focus on cash flows to shareholders, which are dividends or free cash flows to equity. At some point, once the firm is stable, we compute a terminal value using our perpetuity formula. Finally, we discount everything back at the appropriate rate. The cost of equity for shareholders, or weighted average cost of capital if we are valuing the firm. Cost of equity for shareholders, or weighted average cost of capital if we are valuing the firm. This is the general roadmap behind all DCF valuation. Here is a specific flowchart for dividend-based valuation. Start with net income, multiply it by the payout ratio to get dividends. Then factor in growth, which depends on reinvestment and return on equity. Once dividends are projected, we discount them back at the cost of equity. That gives us the value of equity. At the bottom, you see how the cost of equity is determined. It comes from risk-free rate, adjusted for risk premiums. Those risk premiums capture business risk, financial leverage, and country-specific factors. So, this diagram ties together the two big drivers of equity value: expected dividends and required return. Up until now, we've been focusing on dividends. But sometimes it's more practical to value a company using free cash flows instead. Free cash flow is the cash that remains after the firm has covered operating expenses and reinvested enough to maintain or grow the business. Free cash flow is the cash that remains after the firm has covered operating expenses and reinvested enough to maintain or grow the business. Free cash flow is the cash that remains after the firm has covered operating expenses and reinvested enough to maintain or grow the business. In other words, it's the money available to be distributed to investors, either as dividends, share repurchases, or debt repayment. The idea is the same as with dividends. We estimate those future cash flows, then discount them back to today at the appropriate rate. The difference is that here we are not limited to dividends, which may be irregular or even non-existent. Free cash flow gives us a broader, cleaner measure of the firm's value. Another angle is to value the entire firm, the enterprise value. The enterprise value. Here, instead of looking only at equity cash flows, we consider all cash flows the business generates before payments to debt and equity holders. Then we discount them Then we discount those at the firm's weighted average cost of capital, or WACC. Once we get the total enterprise value, we subtract that to find the equity value. This approach is widely used in practice, especially for companies that don't pay dividends or are heavily levered. So whether we focus on dividends, free cash flow to equity, or enterprise cash flow, the principle is identical. We first estimate future cash flows and then apply the right discount rate. We estimate future cash flows, apply the right discount rate, and get a present value. Now, before we jump into equity valuation formulas, let's take a pause for Now, before we jump into equity valuation formulas, let's pause for a quick review. A growing annuity is a stream of payments that not only ends after a certain number of years, but also grows at a constant rate each year. Think of it like this. Imagine receiving $100 next year, then 5% more each year after, but only for 10 years. That's a growing annuity. When we value a growing annuity, we take into account both the growth in payments and the fact that they end after a fixed horizon. The result is smaller than a growing perpetuity because the payments don't last forever. Now compare that to a growing perpetuity. This is a payment stream that grows at a constant rate but goes on forever. The most important example for us is dividends. Think of a dividend that grows at a constant rate forever. That's the exact setting for the golden growth model, which we will go That's the exact setting for the golden growth model, which we will cover soon. Intuitively, the value of a growing perpetuity equals next year's payment divided by the difference between the discount rate and the growth rate. Why does that make sense? The denominator captures two opposing forces: the discount rate, which shrinks future cash flows, and also the growth rate, which makes those cash flows bigger over time. So when growth rates get closer to the discount rate, value shoots up because payments are growing almost as fast as we are discounting them. This chart summarizes the four main cases. Constant annuity, which is fixed payments that end after n years. Growing annuity, where payments that rise over time but stop after n years. Constant perpetuity is when fixed payments that last constant perpetuity gives us fixed payments that last forever. And finally, growing perpetuity that gives us and finally 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 growing perpetuity and finally growing perpetuity that gives us that gives us that gives us and finally growing perpetuity that gives us rising payments that last forever. Why do we care? Therefore, equity valuation models are really just different applications of this. In fact, equity valuation models are really just different applications of these four cases, depending on how dividends behave. That's the beauty of connecting time value of money to stock valuation. So now is the time to start with the simplest case, zero dividend growth. Imagine a stock that pays the same dividend every single year forever. The timeline here shows a flat stream of payments. For stock valuation, our focus will be focusing For stock valuation, our focus will be on the right side of this chart. For stock valuation, our focus will be on the right side of this chart, growing perpetuity and growing annuity. So now is the time to start with the simplest case, zero dividend growth. Imagine a stock that pays the same dividend every single year, forever. The timeline here shows a flat stream of payments, identical each year. If you can see the pattern here, you are right. It's just a perpetuity. That means the stock's price today equals the dividend divided by the required return. That means the stock's price today equals the dividend divided by the required return. That means the stock price today equals the dividend divided by the required return. This case is rare for Actually, this case is very rare for common stock, but it's exactly how we value preferred stock. Since preferred shares pay a fixed dividend indefinitely. Suppose a firm promises to pay However, a share of common stock in a company with a constant dividend is much like a share of preferred stock. If we think of the example that a firm promises to pay $2 every year and the required return for investors is 8%, the stock's value is like asking how much would you pay today to receive $2 forever if you discount at 8%. We know from perpetuity logic that you'd pay the firm will pay a constant dividend forever, and the price is computed using the perpetuity formula. Because for a zero growth share of common stock, this implies that D1 equals to D2, D1, D2, D3. This implies that all the dividends are equal to each other, which equals to a constant, So the value of the stock of zero dividend growth is exactly the perpetuity formula. So what's exactly a preferred stock? It is a real-world preferred shares promise a fixed dividend, often stated as a percentage of face value or a fixed dollar amount. Because these dividends are assumed to continue indefinitely, the perpetuity formula fits perfectly. That's why preferred stock is often described as a perpetuity in finance. Here's an example. Suppose you paid $34.25 for Here's a real-world example. Suppose you paid Here's an example. Suppose you paid $34.25 for a share of preferred stock, and it pays an annual dividend of $2.1. What's your required return? You simply divide the dividend by the price, $2.10 divided by $2.10 divided by $34.25, which gives us about 6%. So if you bought this stock, you'd be earning a 6.1% return every year in perpetuity. Notice how straightforward this model is when dividends don't grow. Notice how straightforward this model is when dividends don't grow. Now let's make things more interesting. The constant growth case. Suppose dividends don't stay flat, but instead increase by the same percentage every year, say 5%. The timeline now shows payments that rise steadily year after year, forever. So how can we value this? Well, it's a growing perpetuity. You start with the next year's dividend, not this year's, but the one coming up, D1. Then you divide that by the required return minus the growth rate. Why this formula? Because the required return reflects how much investors demand for taking risk, while the growth rate reflects how much the cash flows expand each year. The difference between the two tells us the effective discounting of the growth. The difference between the two tells us the effective discounting of the growing stream. This is the famous Gordon growth model, and is one of the most widely used tools in finance. Now let's dig deeper into the constant dividend growth model. The assumption here is that dividends increase at a fixed percentage every single year. For example, if the company just paid $3 and the growth rate is 6%, then next year's dividend will be 3 multiplied by 1.06 or 3.18%, $3.18 or $3.18. The year after, we take this 3.18 times 1.06 again, and so on. The key condition is that the growth rate has to be less than the required return. Otherwise, the math breaks down because you can't have dividends growing faster forever than the rate at which investors discount them. So how do we value this? We treat it as a growing perpetuity. Think of it like this. You line up all those future dividends, each one a little bigger than the last, each one a little bigger than the last, each one a little bigger than the last one. Then you discount each one back to today. If you add them up, you get a neat and elegant result, which is the price today equals next year's dividend divided by the required return minus the growth rate, D1 over R minus G. The intuition is that start with the size of the cash flow you will receive soon, which is the next year's dividend. Then ask yourself, how much more are those dividends growing each year? That's the growth rate. Finally, compare that growth to the return investors demand. The bigger the spread between return and growth, the smaller the present value. And in contrast, the smaller the spread, the higher the value. So stock price rises when dividends are expected to grow faster. So stock price rises when dividends are expected to grow faster, and it falls when investors demand a higher return. This elegant formula is known as the Gordon growth model. So let me formally introduce the Gordon growth model. It's one of the famous. So let me formally introduce the Gordon dividend growth model. It is one of the most famous results in finance because it links price directly to three simple inputs: next year's dividend, the required return, and the growth rate. A really nice feature is that you can use it not just for today's price, but also for the price at any point in the future. You simply adjust the dividend for however many years of growth. You simply adjust the dividend for however You simply adjust the dividend for however many years of growth have occurred by then. You simply adjust the dividend for however many years of growth have occurred by then, and divide by the same return minus growth gap. The model works best for mature, stable firms where growth is relatively steady. This model will work best for mature and stable firms where growth is relatively steady, like utilities or consumer goods companies. It's less reliable for startups or firms with volatile earnings. Let's try an example. Suppose a company has just paid a dividend of $3 per share, and dividends grow at 8% per year. The question is, what will the dividend be in 5 years? We start with today's dividend, $3. Then we multiply by 1 plus the growth rate, 5 times in a row. So $3 times 1.08 to the fifth power. That gives us about $4.41. So the dividend will increase by $1.41 over the next 5 years. This shows how quickly growth compounds, even over a relatively short period. And here is another example using valuation. Suppose the next dividend for a company will be $4. Investors require a 16% return, and dividends are expected to grow at 6% annually. The first step is to take the next dividend, which is $4. And second, we subtract the growth rate from the required return. 16% minus 6% leaves 16%. 16% minus 6% leaves 10%. And the third step is to divide, and the third step is to use 4 divided by 0.1, which is equals to $40. And the third step is to use 4 and divide it. And the third step is to divide the $4 by 10%, which gives us $40. Now suppose we want to know the price 4 years from now. By that time, the dividend will have grown for 4 years. So we take $4 times 1.06 to the power. So we take $4 times 1.06 to the fourth, which gives the 50-year dividend. Which gives the 50-year dividend. Then we can divide by the same return minus growth gap. That gives a price of about 50.5 per. That gives a That gives a price of about $50.5 in 4 years. This example shows how the golden growth model not only values a stock today, but also projects its price into the future. Now, in reality, not all companies grow at a constant rate. Many firms go through life cycle stages. A young firm might grow very quickly in its early years. Reinvesting everything to expand, but eventually that rapid growth slows. And the firm settles into a more stable, mature phase with slower growth. To handle this, we use the non-constant growth model. The idea is simple. In the early years,
Project dividends year by year.
In the early years, project dividends year by year, even if the growth rates vary. After some point, assume the firm growth stabilize. Assume the firm growth stabilize at some point, assume growth stabilizes at a constant rate, and then we can apply the golden growth model to calculate the terminal value, or the price at the start of the constant growth phase. Finally, we discount everything back to today. This approach is flexible enough to handle firms with different stages of growth. Here's a very important warning. The most common mistake in these models is misplacing the transition to constant growth. You must be clear on when the constant growth begins, because that's when you calculate the terminal value. If you put that value 1 year too early or too late, your entire value will be off. So always double check your timeline and make sure you know exactly which dividend marks the start of steady growth. So be sure to always double check your timeline and make sure you know exactly which dividend marks the start of the steady growth phase. Now we can finally delve into the non-constant growth case. Now we can delve into the variable growth case. Suppose we have n years of unusual, possibly rapid growth. For each of those years, we calculate the dividends individually and discount them back individually. Then, at year n, we assume the company transitions to a constant growth rate. Let's call it G2. At that point, we calculate the terminal value, which is the price at the start of the constant growth phase. Then terminal value equals the dividend That terminal value equals the dividend in year n+1 divided by the difference between the required return and the constant growth rate. Finally, we discount that terminal value back to today along with the early dividends. So the stock's value today equals the present value of the dividends during the high growth phase plus the present value of the terminal value at the transition point. So the stock's value today equals the present value of the dividends during the initial growth period plus the present value of the terminal value at the transition period. So the stock's value today equals the present value of the dividends during the initial growth period plus the present value of the terminal value at the transition point. So the stock's value today equals the present value of the dividends during the initial growth period plus the present value of the terminal value at the transition point. A common special case of this is the two-stage growth model. Here we assume the company grows at a Here we assume the company grows at one constant rate, say 20% per year, for a fixed number of years. Then after that period, it switches to a lower sustainable constant growth, like 5%. Here we assume the company grows at a one constant rate, say 12% per year, for a fixed number of years. Then after that period, it switches to a lower sustainable constant growth rate. It switches to a lower sustainable constant growth rate, like 4%. The logic is the same as before. Project dividends in the first stage, then calculate a terminal value at the start of the second stage, and discount everything back to today. This model is often used for young, fast-growing companies that are expected to eventually mature. This model is often used for young, fast-growing companies that are expected to eventually mature. Let's try a specific example. Suppose we forecast the following dividends: $1 next year, $2 in year 2, and $2.5 in year 3. After year 3, dividends are expected to grow at a constant 5% forever. The required return is 10%. How do we value this stock today? A general picture is that in step 1, we discount the first 3 dividends back to today at one at a time. And in step 2, at the end of year 3, we calculate the terminal value using the Gordon model. That means take the year 4 dividend, which is $2.5 times 1.05, and divide by the required return minus the growth rate. In step 3, we discount that terminal value back to today, and finally, we add everything up. Again, the important thing here is to notice when constant growth starts. This is very critical. In this example, the constant growth starts at time 3, which means we can use our constant growth model to determine the stock price at time 3. The value of stock is the present value of all the future dividends. To calculate this present value, we first have to compute the present value of the stock price 3 years down the road. Again, the procedure is like this. We first have to compute the present value of the stock price 3 years down the road, and then we have to add in the present value of the dividends that will be paid between now and then. So again, the procedure to calculate the procedure is like this. We first need to compute the present value of the stock price 3 years down the road, and then we add the terminal value at year 3. So again, the procedure is like this. We first have to compute the present value of the stock price 3 years down the road, and then we add it together with the terminal value at year 3. So the procedure is like this. We first discount the near-term dividends one by one, calculate the terminal value at the point when growth stabilizes, which is time 3, and bring that back to today. We add the two components together, and this is the standard pay, and this will give us the stock price today. Here is the calculation steps, and you can check your work here. Here is the calculation steps, and you can check your work. This slide shows the calculation steps, and you can check your work. Now let's formalize the two-stage growth model, which is really just a special case of the non-constant growth model. Here the company grows at one rate, let's call it G1, for a set number of years. Then starting in year n+1, it shifts to a second lower rate, G2, which continues forever. This is a good approximation for many firms. Think of a startup that grows rapidly in the first 5 to 10 years, and then matures in a stable company with slower long-term growth. Here's how the mechanics work. During the first stage, project each dividend using the higher growth rate. Discount those back to today one by one. At the end of that stage, calculate the terminal value. To do that, take the dividend in the next year, the first year of stable growth. To do that, take the dividend in the next year, that is the first year of stable growth, and divide it by the required return minus the long run growth rate. Finally, discount that terminal value back to today and add it to the discounted early dividends. So, in words, the stock price today equals the present value of dividends during the supernormal growth period plus the present value of the terminal value once the firm settles into constant growth. Let's apply the principle with a real exercise. Suppose wireless energy company has just paid a dividend of $1.5 per share. For the first 7 years, dividends are expected to grow very rapidly at 22% per year. After that, growth slows to 7% per year forever. The required return is 12%. Our job is to find the intrinsic value of this stock today. So we will first need to project dividends. So we need to first discount dividends for the first 7 years using 22% growth. And then we calculate the terminal value at year 7 using the Gordon growth formula with the 7% long-term growth rate. Finally, we will discount both the early dividends and the terminal value back to today. So we will need to first project dividends for the first 7 years using 22% growth. And then we calculate the terminal value at year 7 using the Gordon growth formula with the 7% long-term growth rate. And finally, we will discount both the early dividends and the terminal value back to today. Let's walk through the solution. At the end of year 7, the dividend will have grown for 22% each year. So year 7's dividend equals $1.5 times 1.22 raised to the 7th power. That comes out to about $6.04. Now to calculate the terminal value at year 7, we take the year 8 dividend. That's about $6.04. And we time it and we take the year 8 dividends times 1.07. We take the year 8 dividend, that's year 7's dividend times 1.07, and divide it by the difference between the required return and the stable growth rate, which is 12% minus 7%, which is 12% minus 7%, or 5%. So the terminal value at year 7 is about $129. Now we discount everything back to today. The stream of high growth dividends adds up to about $36. We add up together the stream of high growth dividends and the discounted terminal value, and which gives us the stock's price, which gives us the stock's intrinsic value today is around $73. This shows how powerful the two-stage model is for valuing companies that have an entire This shows how powerful the two-stage model is for valuing companies that have an early rapid growth phase followed by stability. This shows how powerful the two-stage model is for valuing companies that have an early rapid growth followed by stability. This shows how powerful the two-stage model is for valuing companies that have an early rapid growth phase followed by stability. Let's now step back and look at the required return. From the Gordon growth model, we know the stock's price equals next year's dividend divided by the required return minus the growth rate. If we solve this for the required return, we get an important insight. The required return is actually equals the dividend divided. The required return equals the dividend yield plus the growth rate. In plain words, the dividend yield is next year's dividend divided by today's stock price. This is like the income return, similar to the current yield on a bond. The growth rate represents the capital gains you expect as dividends and prices grow over time. So equity returns come from two sources: cash income through dividends and price appreciation through growth. Let's try a quick calculation. Suppose a company is expected to pay a dividend of $3 next year. Its stock price today is $50, and investors require a 50% return. We can then back out the implied growth rate. First, compute the dividend yield. $3 divided by 50. Now, since the required return is 50%, first compute the dividend yield. $3 divided by $50 equals 6%. Now, since the required return is 15% and required return equals dividend yield plus growth, the growth rate must be 50% minus 6% or 9%. If we use the formula from the previous page, you will get the same result, 9%. So investors expect this firm's dividends to grow at 9% per year. Let's now look at a slightly trickier version. Suppose the current dividend is $3, the stock price is $50, and the required return is still 50%, and the required return is still 15%. Notice the difference here. We've been given the current dividend, not next year's dividend. We've been given the current dividend. We've been given the current dividend, not next year's dividend. That means we need to adjust. The growth rate G must satisfy this relationship. Required return equals dividend yield based on next year's dividend plus G. But next year's dividend is today's dividend times 1 plus G. So the equation is 50% equals 3 times 1 plus g divided by 50 plus g. If you solve that equation, you find the growth rate is about 8.5%. This shows how careful you need to be with the timing. This shows how careful you need to be with the timing of dividends. Whether you are given the current dividend or the expected next dividend makes a big difference in the calculation. Finally, let's note that we can extend the two-stage model to multiple stages. For example, a company might grow at 12% for the first 5 years. For example, this graph shows a multi-stage growth model. The process to find the present value of the process to find the present value of the dividend. The process to find the present value of the dividend is the same. We first forecast dividends year by year for each stage. And at the end of the last stage, we calculate the terminal value using the Gordon growth model. And then finally, we discount everything back to today. This flexibility makes dividend discount models powerful. This shows the flexibility that dividend growth model. This shows the flexibility that dividend This shows the flexibility that dividend growth. This shows the flexibility in discount. This shows the flexibility in the dividend discount models in handling firms with complex growth patterns. Although the more stages we add, the more assumptions we are making. Up to this point, we've treated growth as something that just happens. But where does growth really come from? It's a problem. It's a question. But where does growth really come from is a question. It comes from how much of the firm's earnings are reinvested back into the business. The retention ratio, also called the plowback ratio, measures the percentage of net income that a company keeps instead of paying out as dividends. For example, if a company earns $100, $100 million in net income and pays $40 million in dividends, then it has a payout ratio of 40%. The retention rate is the remainder, 60%. Intuitively, the higher the retention rate, the more money is being reinvested to fuel future growth. But it also means less cash is being returned to shareholders today. Now let's connect retention to growth. The sustainable growth rate is how fast a company can grow its dividends and earnings without raising additional equity. It depends on two things: profitability, which is measured by return on equity or ROE, and the retention ratio, and also the retention rate. The formula is growth equals ROE times the retention ratio. The formula is growth equals ROE times the retention rate. Here's the intuition. For every dollar of earnings, the company retains some percentage, and each retained dollar earns the firm its ROE. Multiply those together, and you will get the contribution to growth. As a numerical example, if a company has a 20% return on equity and retains 50% of earnings, then growth is 10%. Then growth is 20% times 50%, which equals to 10%. That's how fast dividends can grow in a self-sustaining way. That's how fast dividends can grow in a self-sustaining way. Let's try this with numbers. Suppose Computer Corp reinvests 60% of its earnings. Its stock sells for $50. The next dividend will be $2.5, and the discount rate is 50%, and the discount rate is 15%. First, compute the dividend yield. $2.5 divided by $50 equals 5%. Since the required return is 15%, the discount must be the growth rate, which is 10%. Now, to bank out ROE, we divide the growth rate by the retention rate. That's 10% divided by 60%, which equals about 16.7%. So this tells us that companies' reinvested earnings are generating a return of 16.7%. This is a nice way to link valuation to real business performance. Now here's a natural question. What if a company doesn't pay any dividends at all, or its cash flows are highly unpredictable? Do we just give up on valuation? The answer is no, absolutely. The answer is no. This is where the discounted cash flow approach breaks down. But this is where the discounted cash flow approach breaks down. This is where the discounted cash flow approach breaks down. For example, early stage tech. Now I want you to consider this Wall Street interview question. What if a company doesn't pay dividends, or its cash flows are highly unpredictable? Do we just give up on valuation? The answer is no. But this is where the discounted cash flow approach breaks down. For example, early-stage tech companies or biotech startups may reinvest everything, so they have no dividends. Financial institutions like banks have very complicated balance sheets, making free cash flow tricky to define. So in these cases, analysts often turn to a different approach, valuation using multiples. That is valuation using multiples. In fact, one of the most common shortcuts in practice is using multiples. The most popular is the price-to-earning ratio, or PE ratio. Here's how it works. We first find a benchmark PE ratio, maybe the industry average or a peer company's ratio. Then multiply that by your company's earnings per share. Then multiply that by your company's earnings per share to get a value estimate. For example, if the industry average PE ratio is 20 and your company earns $5 per share, then an approximate price is 20 times 5, or $100. The idea is that similar companies should trade at similar multiples. This makes valuation quick and intuitive, though less precise than the DCF model. To better understand multiples, let's review the pieces. To better understand multiples, let's review the pieces. Earnings per share, or EPS, equals net income divided by the number of shares outstanding. Earnings per share, or EPS, equals net income divided by the number of shares outstanding. If a company earns $300 $363 million, for example, if a company earns $363 million, and has 33 million shares, then EPS is $11. The PE ratio is simply price per share divided by earnings per share. So if the stock price is $88 and EPS is $11, then the PE ratio is 8. That means investors are willing to pay $8 for every $1 of earnings. The higher the PE ratio, the more optimistic investors are about the firm's growth perspectives. The higher the PE ratio, the more optimistic investors are about the firm's growth prospects. The higher the PE ratio, the more optimistic investors are about the company's growth prospects. A natural question is, why does P ratio matter? Because it captures the market's expectations. A high PE usually means investors believe the firm has strong growth opportunities. But you need to be careful. Sometimes a high PE just means earnings are temporarily low. For example, a company that barely breaks even might show a huge PE ratio. But that doesn't necessarily mean investors expect growth. So always interpret PE in context. Look at industry peers. We need to look at industry peers, the company's history, and the broader market. We need to look at industry peers, the company's history, and the broader market. The benchmark PE model is presented as the following. Price at time 0 equals to the benchmark PE times the earnings per share at time 0. And if we are interested in the target price or P1 equals to the benchmark PE times the earnings per share at time 1. So if we want to find the EPS 1, we can just use EPS 0 times 1 plus the growth rate. So let me give you a very quick example. So let me give you a very quick example. So let me give you an example. Suppose the benchmark PE ratio for an industry is 16. If our company's current earnings per share are $3.7, then multiplying these two gives us a benchmark PE ratio about $59.2. We can also project forward. Then we project it forward. If earnings are expected to grow, say by 10%, then next year's EPS 1 will be then the next year's EPS, or EPS1, will be 3.7 times 1 plus 10% growth rate, or about $4.07. Multiply that by 16, and we get a forecasted price of about $65.1. Multiply that by 16, and we get a forecasted price of about $65.1. Now, let me formally introduce the benchmark PE model. Price at time 0 equals to the benchmark PE times earnings per share at time 0. And the target price, or P1, equals to the benchmark PE times the earnings per share at time. And the target price, or P1, equals to the benchmark PE ratio times the earnings per share at time 1, where EPS1 equals to EPS0 times 1, where EPS1 equals to EPS0 times 1 plus the growth rate. Let me give you an example. Suppose the benchmark PE ratio for an industry is 16. If our company's current earnings per share are 37, if our company's current earnings per share are $3.7, then multiplying those two gives us about a value estimation of about 5. Then multiply those two gives us a value estimate of $59.2. We can also project it further. We can then project it forward. If earnings are expected to grow, say, by 10%, if earnings are expected to grow, say, by 10%, then next year's EPS, or EPS1, will be 3.7 times 1 plus the growth rate 10%, or about, and we will get about $4.07. Multiply EPS1 by the industry benchmark PE ratio, 16, and we will get a forecasted. Multiply EPS1 by the industry benchmark PE ratio, we will get a forecasted. Multiply EPS1 by the industry benchmark PE ratio, and we will get a forecasted price of about $65.1. So multiples allows us to quickly estimate both today's price and tomorrow's price without going through detailed cash flow projections. So multiples allows us to So multiples allows us to quickly estimate both today's price and tomorrow's price. Before ending today's lecture, here's something important. The PE ratio is really tied to growth opportunities. In fact, we can think of the stock's price as having two parts. First, the value of assets the firm already has in place. And second, the present value of growth opportunities. If growth opportunities are zero, the stock price looks like If growth opportunities are zero, the stock price looks like earnings divided by the required return, just like a perpetuity with no growth. Just like a perpetuity with no growth. In that case, the PE ratio is simply 1 over the required return. But as growth opportunities, however, as growth opportunities become more valuable, growth opportunity. But as growth opportunities become more valuable, the PE ratio rises. That's why high growth firms tend to have very high PE multiples. It really reflects the market's optimism about the future. Let's close the session with an example. Suppose the shoe industry has an average PE ratio of 16.
Nike.
And Nike currently earns $3.7 per share. And Nike currently earns $3.7 per share. Using the benchmark, today's price estimate is 16 times 30. Using the benchmark, today's price estimate is 16 times 3.7, which is about $59. Now let's forecast. Nike's return on equity is 18%, and its payout ratio is 28%. That means its retention rate is 72%. Multiply ROE by the retention rate, and you will get a growth rate of about 13%. So next year's EPS will be 3.7 times 1.13, or about $4.18. So next year's EPS will be today's price times 1 plus the growth rate. Multiply that by 16, and we will get the forecasted price. I will leave the calculation to yourself. This shows how multiples give us a quick, market-based way to project stock prices. The key, of course, is choosing the right benchmark PE. If the comparison is poor, the estimate can be misleading. Let's talk about Now it's time to talk about why multiples are so popular in practice. First, they are fast and simple. You don't need to project detailed cash flows far into the future. Just find a benchmark ratio and apply it. Second, multiples are easy to understand and communicate. If you tell an investor that a stock trades at 15 times earnings, if you tell an investor that a stock trades at 15 times earnings, that's immediately meaningful. Third, multiples are easy to defend. If the whole industry trades around a certain PE, it makes sense to use that as a reference. And finally, multiples reflect market dynamics. Because they are based on actual market prices, they capture the current sentiment and conditions in the industry. Of course, multiples have some serious drawbacks too. The biggest issue is finding truly comparable The biggest issue is finding truly comparable companies. No two firms are identical. So using a benchmark PE is always an approximation. Also, multiples can ignore fundamentals. If the market is overvalued, your multiples-based valuation will be too high. If the market is undervalued, it will be too low. Furthermore, multiples are unstable over time. As industries evolve, technologies change, or investor sentiment shifts, the typical P As industries evolve, technologies changes. As industries evolve, technologies change, or investor sentiment shifts, so the typical PE ratio can move dramatically. That makes comparisons across time difficult. So, while multiples are quick and intuitive, as a result, while multiples are quick and intuitive, they should never be your only tool. They are best used as a cross-check alongside discounted cash flow models. They are best used as a cross-check alongside the discounted cash flow models. They are best used as a cross-check alongside discounted cash flow models. Let's wrap up today's lecture. We begin with the principle that stock value comes from the present value of future cash flows to shareholders. We built models around different dividend patterns. Zero growth, which mirrors
Mirrors.
mirrors, which mirrors
Mirrors.
mirrors zero growth, which mirrors preferred stock, constant growth, leading to the Gordon growth model, and finally, non-constant and two-stage growth, which capture the life cycle of real, and finally, non-constant and two-stage growth, which capture the life cycles of real firms. We then explore the role of retention rates and return on equity We then explore the role of retention rates and return on equity in driving sustainable growth. In the second part, we turn to multiples, particularly the PE ratio. We saw how multiples are quick, easy, and we saw how multiples are quick, easy, and reflective of the market, but also how they can be misleading if used in isolation. The key takeaway is that equity valuation combines theory and practice. Dividend discounting gives us a rigorous intrinsic framework, while multiples give us a market-based shortcut. Together, they provide a fuller picture of what a stock is worth. Thank you for watching, and I will see you in the next video. Thank you for watching, and I will see you in the next video. Thank you for watching, and I will see you in the next. Thank you for watching, and I will see you. Thank you for watching, and I will see you in the next video.